Hi, everybody. Welcome to Stop Being Sold, a community of informed consumers who are sick and tired of being sold financial products that they don't understand or need. So if you're tired of being a transaction, go ahead and hit that subscribe button so you never miss another video from us. My name is Michelle, and this is Brian. How are you today, Brian?
Good. Hey, everyone.
All right. So today we're talking about how are annuities taxed, but I know, right? It's a big one, and it's important. It's really important. The more that I learn about annuities, the more I'm like, wow, you can take a heavy hit if you're not dealing with an advisor who puts your interests above everyone else. So a fiduciary. But also just really understanding the fine print in these annuity contracts.
Exactly.
So to back it up real quick, what is an annuity? An annuity is basically a long-term contract with an insurance company. It's where you put your money, it grows, and in return for your investment, you get income in the form of regular payments. You can also cash them out. I mean, it's, kind of sounds like a retirement plan. It also sounds like a retirement plan. Am I right?
Yeah, especially the fact that, think about this, Michelle, all annuities, no matter what type it is, grow tax deferred, meaning that you don't pay any taxes until you take a distribution out of it, like you said, regular payments or a cash withdrawal out of it. So again, it definitely sounds like a retirement plan.
For sure. All right, well, let's dive in. I'm going to turn it over to you. What do we need to know about annuities and taxation?
Okay, so we're going to break down a couple sections of what they are. But first, remember this. When you take a withdrawal, whether it be a cash withdrawal or an income payment, you're taxed as normal income, not on capital gains rate, which are usually more favorable to you, the consumer. So,
right.
And how much you pay is based on how the annuity account is set up in the beginning.
So how much you pay in taxes is
how much you pay in taxes is based on how the account is set up in the beginning.
Okay.
I'm going to break that down into two different sections. Let's say, for example, you fund your annuity with pre-tax dollars, like an IRA or a 401k rollover.
Or a Roth IRA as well, right? Traditional or?
Yeah, Roth could be inside this also. So any of these pre-tax dollars, you pay taxes as normal income in the year that you take a distribution. This is what's called a qualified annuity, okay? Very similar to an IRA account, whether it be a brokerage account that has that's labeled as an IRA. Exact same way, you pay taxes as income. So, for example, let's say you take a $20,000 withdrawal. $20,000 will be added to your taxable income in the year that you have it distributed to you, since no taxes have been paid on this money prior to this date.
Now you pay. So let me just real quick. So let's say that I make $60,000 this year in 2021, and I decide that I'm going to take a one-time withdrawal, or I'm going to cash out this IRA. This annuity, right? This qualified annuity. That means that $20,000 will be added to my 60, which means I will be taxed on $80,000 of earned income when I go to pay my taxes in April next year.
You're exactly right. That's
got it.
Pretty simple. But don't forget that because this is an IRA, if you take out the funds prior to the age of 59 and a half, IRS will now also charge you a 10% penalty on the amount withdrawn.
Okay. All right. And what penalties are there for, let's talk about Roths and how they fit in the Roth IRA.
Okay. So for example, with the Roth, very similar. Everything's growing tax deferred, any type of annuity, right? So these will still be tax-free income to you in retirement as long as you meet all the Roth requirements, such as holding the account for more than 5 years and you take your distributions after the age of 59 and a half. So not only these grow tax deferred, but the Roth annuity will be tax-free for you if you meet them two requirements.
Understood. Okay. So is there anything else about qualified annuities that you want to cover before we go on to non-qualified annuities?
No, it's pretty simple. Just compare it to a normal IRA account. So
Okay. All right, great. So let's talk about this, the non-qualified annuity.
okay. So a non-qualified, in simpler terms, is an annuity that you pay for or fund with after-tax dollars. So this could be money sitting in your checking account, savings account. That's how it's configured. Remember, though, it can still, it's an annuity, so it's growing tax deferred. Okay. Mm-hmm. These annuities, though, are different in the way they're taxed because you're only taxed on the gains or the earnings inside the account since the contributions were already taxed.
Right.
And you're not charged, again, for this, they grow tax deferred until you make a withdrawal.
Okay. Or you start getting regular payments.
Yes.
And that is a withdrawal, right? So it can be withdrawing each monthly regular payments, a one-time, withdrawal, or cashing the whole thing out.
Yeah. So any withdrawal, you're tax deferred until that date. Okay. So how do you figure out the gains and determine how much is taxed is next? It's actually pretty simple. So we use what's called an exclusion ratio to figure out how much your payment, whether an income payment or a one-time cash payment, distribution, is taxable and how much is not. So let me give you an example. Let's say your principal payment into this non-qualified annuity with your after-tax dollars is $100,000.
Okay.
Okay. Let's say you let it grow tax deferred for 10 years and it's now worth $150,000. Pretty simple math, right? You've made $50,000. That's your gains. But now you say, I think I'm going to buy my sports car, or I'm going to buy this, or whatever. I'm going to take out $75,000 for a new sports car. Okay. Remember, I said you've gained $50,000. So if you take out $50,000 in gains and $25,000 from the principal, you're left with $75,000, right?
Right.
Okay. IRS mandates that you take your interest out first.
Oh.
So out of $75,000 that you're not thinking of this. You're thinking of, I'm just going to take $75,000.
I get $75,000, right?
IRS is saying, great, Michelle, here's your $75,000. But the first $50,000, which is your gains, we're going to tax that. We're going to tax your interest first. This is what's called LIFO, or last in,
first out.
So we're going to charge you your gains of $50,000 is now going to be taxable income in the year that you withdrew it, and the $25,000 is not taxed. You'll get a 1099 from the IRS, or from the annuity company that you turn in with your taxes, showing a distribution of $75,000 from this account, but then right below it, I think it's box 1 and box 3. Box 3 is going to show the taxable portion of the $50,000.
Because you're paying taxes on the gains.
You got it. That's what's called the exclusion ratio. That's the difference between your earnings and the amount of the principal paid.
Got it. Okay. So are there any penalties?
Yes.
Like for non-qualified?
Yes. Now, most people wouldn't think there would be because, it's a cash account. You've already paid taxes on it. You set it up. You're paying your taxes on your earnings. Wrong. Remember, in the beginning, I said all annuities are tax deferred, very similar to retirement accounts.
Okay.
So, with a retirement account, if you're under age 59 and a half and you take out a distribution, you're penalized 10%, right? That's the exact same that happens in a non-qualified annuity. So you must know that. So let's say you take an annuity out at age 40, it fully matures at age 50, and you say, I made $50,000, I'm taking my money out. And you take out it all. Well, you're being penalized on that early withdrawal because you're not 59 and a half yet.
Got it. So it doesn't matter if it's qualified or non-qualified. You need to be 59 and a half to be able to withdraw or start taking regular
Income
monthly
payment.
income payments
Right.
until that point.
Now, there is a way to bypass the income payments. We can go just real briefly.
Yeah,
If
let's do
you're
that.
taking income payments, there is a way to bypass the 10% penalty if you set it up for lifetime income or past a 10-year period of income off of it. You can bypass that. So there are some guidelines that you can do it. We won't go into great detail, but here's another thing you need to know. On that penalty, let me ask you this. Do you think you're penalized on all the distribution?
I don't know. It's the IRS. I never know.
Great answer. No, the answer is no, though.
Okay.
Okay. You're only penalized on the earnings, not on the principal removed. So if we took out that $75,000, you're only penalized on the $50,000 of earnings.
Got it.
IRS cannot charge you a penalty on removing your after-tax contributions into the
Got it. Okay. All right. That makes sense. So it's only on earnings, not on the principal, which is the same as, what you gave the example. You have 50,000, you had $100,000. You earned 50,000 over the course of 10 years. You want to take out 75. The IRS is only going to tax you on that 50,000. In the 1099 form it'll say the distribution was for 75,000, but the taxable portion is 50,000.
You got it. And if you're under 59.5, the 10%,
and the same thing with the penalty.
Still on the 50,000.
All right. Okay. Got it. So really, you said this early on, you set it up for us. How much you're going to pay in taxes depends on the type of account you set up, how it's set up from the get-go. So
you wouldn't think about this. And here's the importance of having a professional advisor that
fiduciary
knows, and that truly knows the tax implications of setting up this account. So very careful on it.
Absolutely. And also someone who like I said, fiduciary, someone who puts your interests ahead of their own and aren't just going to sell you something because if you made it this far in the video, you're realizing that you can get screwed real quick on these. You think you're doing something, you think you're preparing for the future and you're doing something good. You're like, look at me. This is my experience. I'm all like, look what I just did. I set this up. I'm funding this. And you're like, yay, yay, yay. And accumulation phase is great until it comes time to, what's that? The chicken come home to roost. you truly pay up.
The importance of truly knowing what you're purchasing.
Right.
And once you have the facts to go buy, let's say I want an annuity. You don't just hop up and wake up, I'm going to go buy an annuity today, right? That just don't happen.
No, nobody does that.
You truly understand how they're going to benefit you and you buy it for the benefits and the value of that. Right. Then you want to know which one to be set up in the right way and which one's going to be the most beneficial to you and not penalize you in the long run. So absolutely.
And so 2 things real quick. If you're finding this the content of this video valuable, go ahead and hit that like button. We'd really appreciate it. And also subscribe if you haven't already. The second thing is, Brian, it really goes back to you as a consumer need to understand what you're purchasing, not what's being sold to you. So we did a video called The Types of Annuities. We break it down, talk about variable, talk about index, talk about all these different ones. I highly suggest you check that video out. Especially if you're, maybe you already have an annuity. It might be, it's even if you already have an annuity, it's really important to know what you have. And so you can understand the tax consequences later on and plan accordingly.
Right. Definitely.
I have one question.
Yeah, go ahead.
Oh, sorry. Go ahead.
I'll drop the link to that video below here also so you can learn the different types of annuities. But what's your question, Michelle?
So the question is, can you roll annuities over? Like, for example, if I had, I don't know, pick one. Let's say I had a fixed annuity and I do my research and I realize, and this actually did happen to me. This happened. I cashed it out and rolled it into an IRA, right? But I paid the penalties and did whatever because I didn't realize what I flipping had. I was literally just sold something. I was like, I need to save for the future. And someone's like, do this. And I said, okay. Because it sounded good. I sounded responsible. And every month I contributed to it, right? And I ended up taking a very big hit on the whole thing.
That's
And
why you see so much negativity about annuities in the news.
Right, absolutely. Well, and they're not, they are fairly straightforward, but also there's all these if, and, or, nor, but fors. I mean, the taxation alone is not, it is pretty simple, but it's also, I mean, it's yet, you got to look line by line and really make sure you understand every tiny detail. So other than cashing something out, can you roll over, like, for example, I don't know, a fixed annuity to a variable, or does it work like that?
Yeah, no, it does, because remember, they're all retirement plans, right? So whether it's an IRA or Roth IRA, you can roll an IRA to another IRA. So let's say your fixed annuity might have been a 10-year fixed annuity.
Okay.
And into the 10 years, the rates have dropped. And you're like, oh, okay, well.
Or you're not 59 and a half yet.
Yeah. So you're
That
also
one.
roll it to another annuity, or remember, it's an IRA. It can roll. It don't have to go to an annuity. It can go to an IRA CD. It can roll to an IRA mutual fund account or a IRA index account. So there's a lot of different things. So as long as you keep it the same status, you can't do that with the non-qualified though.
That's the key. So,
yeah,
okay,
so
that's the key to understand there.
But you can roll from a non-qualified to another non-qualified, but there's a certain form and a way that it has to be done so you continue letting them gains continue to grow.
Understood.
And there's which has cost basis and all that. And I'm glad you brought this up, Michelle. We will make a video just to understand of how to roll an annuity to another annuity.
Absolutely.
And what the implications are, because there are some gotchas that you have to watch for in there. And that will be one of our next videos.
Sounds good. All right. Well, thank you, Brian, for sharing all this information with us. And thank you, everybody, for watching. And again, if you found this content valuable, please go ahead and hit that thumbs up button, hit that subscribe button, and also subscribe. Did I say subscribe? But hit the like button and subscribe to the channel so you never miss another video from us.
Definitely.
Thanks, everybody.
Thanks, everybody.